Anil Agarwal, Head of Research, Banks, Asia ex-Japan, Morgan Stanley, joins us now in our studio. Anil, good of you to drop in here. Well, let me start with the private sector banks, where there were fewer setbacks. But there was this one big statement which ICICI CEO made, saying that a large number of the NPLs was because restructured loans are slipping into NPLs. Is this a cause for a little longer-term worry on ICICI itself?
First of all, good morning, and thanks for inviting me for this, Lata and Rima. I won't talk specifically on ICICI, but generally for the banking system, and that will apply to any bank with a large restructured loan book. So our view has been that when the restructuring was started 3-4 years back, that's when the first phase of restructuring started. The assumptions which banks made at that point of time was that in 2 years' time, economy will improve. What has happened is that economy has been weaker than where we were 2 years back. So the result of which the mortality of restructured loans into NPLs, our view is that number will remain very high. So the way we calculate it right now, if you look at the exits of restructured loan into either upgrades or downgrades, almost 50 to 60% of all restructured loans which are exiting restructuring are actually becoming NPLs. And that applies to every single bank, be it a state-owned bank, be it a private bank. So as we move into fiscal 16, I think the question or the problem for the banks in India would be that I think the bad loan formation numbers will start slowing down because a lot has already become bad. But provisioning will still remain very high because if you're sitting on a lot of restructured loans, the slippage of that into NPLs will be humongous. And as a result of it, the provisioning catch-up will be quite big. So I think next year the story will be the pace of restructuring slippage into NPLs. And that will be across the board. More so state-owned banks in my view, but generally across the board.
Okay. Within the state-owned banks, where would you place your faith? In any at all? Because that's where the numbers have looked bad. PNB, shot up to over 6%, and that's a large bank, 12 trillion balance sheet.
So we have been bullish on Indian banks for the last 1 year, but we have generally been quite cautious on state-owned banks. So the problem we have with state-owned banks, and I don't want to go into again individual stocks, is that our view is that they just don't have capital. So if you look at some of these state-owned banks, take out the top 2 or 3, they're running with 7 to 7.5% tier 1. If I put my regional hat on, look at banks across Asia, you'll struggle to see any bank which is operating with that kind of CET1. And here you have like multiple banks running at 7 to 7.5, which means they can't lend right now. So if they can't lend,
you don't grow your good balance sheet.
So if you don't grow the good balance sheet, you ultimately are forced to keep giving loans or accrue interest on the bad balance sheet. So as a result of which the problem will just keep getting compounded. So what needs to happen is capitalization of these banks. I think that's the most important thing right now.
Okay. Hi, Anil, and thanks so much for joining in. It's our pleasure. While across the board, many of the PSU banking names have disappointed on the asset quality, are you worried about asset quality in private sector banks? And in particular, what we saw with ICICI Bank, was it a ICICI Bank specific case of asset quality, and would it be a one-off?
I would think that you still have some asset quality issues around private banks, a couple of them for the next quarter or so. Because next quarter is the last quarter when banks can restructure, because after from 1st April onwards, restructuring goes out the window. So I think for private banks, as you go into June quarter, my view would be that any bank which is showing big bad loan formation, numbers will collapse. So private banks I'm generally quite positive on. I mean, some of the private banks, the retail banks, are not showing any asset quality issues, the big ones. Among the corporate lenders also, I think from June onwards, the picture will be very different. And most importantly, they have made provisions. So unlike state-owned banks, when the bad loan formation starts slowing down, the credit cost numbers in the P&L will start coming off, and that will reflect in EPS.
Okay. Just hold on for a minute, Anil. The finance minister is talking at the Mumbai Next conference, which my colleague Shireen Bhan is anchoring. Not very good audio, but let's listen in.
For growth as far as India is concerned. And this is an opportunity we cannot afford to miss. The last 1 decade has been a decade of missed opportunities. We could have come on the faster track if we had kept up the momentum from 1991 to 2004. But a series of indecisions and wrong decisions created a situation for us where we were almost missing the opportunity. But history...
Well, it's at the moment more of historical bashing up of previous governments. it's a discussion on making Mumbai the financial hub. So it would be interesting, but yes, it's a long-term discussion, and the audio needs a bit of fixing. We'll play back that entire chunk to you in course of time. But for the moment, a more absorbing discussion on finance companies with Anil Agarwal, the head of research banks Asia at Morgan Stanley. Anil, do you also cover NBFCs, and do you think that there is a secular story?
So we cover the NBFCs also. So again, the way we look at Indian financial system right now is that 75% of the system is challenged. Again, coming back to the point that I was making on capital. So as a result of which they are unable to grow. So any financial institution which has access to capital and has balance sheet which is reasonably strong from an asset quality perspective, I think they will take away market share in the segment they desire to. So NBFCs, they are very niche players. They are housing finance companies. They are CV finance companies, etc. In the niches that they operate in, the capital ratios are very strong. The balance sheets generally, by and large, is very strong. I think they will keep taking market share away. And then you have interest rates coming down. Wholesale funding cost has come down a long way. Our view is that our economist thinks interest rates will come down a long way over the next 12 months again. These guys are very, very well placed. So it's all about market share game over the next 12 months.
So short point, you will prefer the Shrirams and the Bajajs over the PFCs and the RECs. I mean, it's because one of them has access to more capital.
Yeah, so whoever has access to more capital, I think those guys will keep gaining market share. So again, be it a private NBFC, be it a private bank.
Okay. Are FIs worried about the earnings that we've seen from the banking space this quarter, and are they still putting in money into the banking names despite this weakness?
Generally, people, I mean, in my discussion with investors, they have been quite positive on Indian banks. But the only difference there is that if you look at foreign investors' interest in Indian banks, it's primarily in private lenders, be it NBFCs or banks. And generally, by and large, with the exception of one or two banks there, everybody has shown very strong earnings growth. So my view would be that they will start getting worried or spooked if private banks start missing numbers. But if those banks are showing, like if you look at the private lenders right now, their loan growth is running at 23 to 25%. Their asset quality is fine. Again, putting a regional hat on, I can't see that kind of an EPS growth anywhere else in Asia and actually globally. There's no financial institution which is giving you 25% growth. So as long as they're meeting that number, I think foreign investors will keep giving them money.
Oh, that's very fair. Now, just one more point. One of the incremental occurrences, events in India is that some of the NBFCs could get small bank licenses, and some of them could get payment bank licenses. Would you be bullish on them because of this, and which would be the preference?
Again, I won't talk about which would be the preference, but I think generally it's structurally...
No, would you prefer those who are getting payment bank licenses or attaching themselves to one of them, or those who are at least putting their hat in the ring for a small bank license?
They're a completely different business model.
Absolutely.
So I don't think NBFCs are really going into payment banks. NBFCs are by and large going into small banks. So when I look at the small bank licenses, what it does for an NBFC is that on an upfront basis, it costs them in the form of SLR requirement, CRR requirement, priority sector, or if the foreign ownership is high, they need to bring it down to meet the NOFHC structure. But from a structural perspective, it's actually very good for NBFCs because it increases the terminal growth that investors are willing to pay for non-banks, because otherwise they're wholesale funded institutions, which means they will never be a very high multiple stock. So I think it's a very big positive structurally over the long run for the NBFCs becoming a small bank. Payment bank is a very completely different cup of tea, which I think is again quite a positive for the banking system.
Well, there is an AB Nuvo and the Kotak Mahindra there, but yes, they are the smaller partners. What's the sense on interest rates itself? Since so much of your buying also is hinged on the rate cycle falling.
So the way I look at interest rates is I'm thinking more in terms of bank deposit rates. So if you look at the bank deposit rates right now, we have had a couple of rate cuts, right? So SBI has taken 1-year deposit rate to 8.5%. So right now, if I look at real deposit rate in India on 1-year deposits is about 3.5%. Historically, that number has been about 100, 150. Given that liquidity is reasonably flush in the system, I don't think these guys should be running with that kind of a real deposit rate. So come April, because next 2 months will be tight from a liquidity perspective, I think come April you'll start seeing material deposit rate cuts again. So I won't be surprised if in the next 12 months you see about 100 basis point rate cuts on deposits.
And that will mean poor margins or good margins, smaller margins but larger volumes. How does that make it good? How does that make your choice as an investor?
So generally what happens is that, that's a good point, because generally what happens is that when interest rates go down, margins come off. But this time around, banks have been pretty good in terms of pricing. So while they have cut deposit rates, nobody has touched the base rates. So when rates come down, it is good for volumes, it's good for fee income, it's good for credit costs, and it's good for cost of equity, which means multiples go up. And the only negative is margins come down. So if banks are being sensible there, it's actually a great thing. My view is that even if margins come down, as we have seen in the past, it's okay because volumes will more than make up for it.
All right, Anil, we have to leave it at that. Pleasure speaking with you. Thank you very much for joining us.